Darin Newsom is with us. If you're like me, you probably read something from Darin just about every day on DTN or someplace else. He's going to talk about crop and price outlook, and maybe he can tell us why beans were higher today, other than the reason that we're here at the Soybean Conference and it was the right thing for Chicago to do. Please give Darin a nice, warm welcome. Darin Newsom.
Oh, thank you, Todd. And I do want to tell everybody, my appreciation to the Illinois Soybean Association for the invitation to speak with you here today. Always enjoy getting out in a meeting like this to be able to talk about the markets, particularly when that market has gone up as it did today. It makes it much easier for most groups that I visit with. Now, before we get started, I always like to ask, how many of you are DTN customers or are familiar with the analysis that we do on DTN? I love to see that many hands go up. Okay. Number one, it makes it easy because when I get into the outlook portion, you'll understand how I come up with the ideas that I have, using the methodology that we talk about all the time on DTN. For those of you who aren't customers, take a look at the last slide when we get there. See if you want to go somewhere to help so that you can get back to our website so you can see a little bit more of what we do. All right, what we're going to talk about today is, again, crop and price outlook. This is going to be a very interesting year. There's a lot of things ahead of us, not only in soybeans, but in corn, agriculture in general, the economy, everything. I think this is going to be one of the most interesting years that we've seen in agriculture in quite some time. If we start off though, if we're going to put together an outlook, how do we do it? All right? There's all kinds of, you can sit through a lot of these over the course of the winter. I've been to a lot of these over the course of the winter. You can hear all different kinds of ideas. Most of them come back to just simply going over supply and demand tables. But I think, as those of you who have DTN know, I think there's a lot more to it than that. I think there's more things that we can look at that actually make it simpler than just trying to understand simple supply and demand tables. Every market has a structure. And in order to understand what type of market that we're dealing with, how we should approach that market, what type of strategy we should have in place to manage our risk, we have to understand what type of market that we're dealing with. And it all comes down to these two sides. What's the investment side of the market doing? What's the commercial side of the market doing? What does the market actually believe fundamentals are? And often that is far different than what we see in USDA reports. That's why I look at these two things. I look at these two things only. We can see it in the trend of the future spreads, just simple price direction over time. Just the trend of the futures, price direction over time, and the future spreads, the price relationship between contracts of a particular commodity. That's all we need to know. Once we know what the structure of the market is, once we know what these two sides are thinking, then we can start running it through some filters. Volatility. We've all seen volatility jump. Basically going back to 2005, 2006 when the rules of the game were changed and the doors were flung wide open for all investors globally to come into the markets. The volatility of the market changed. How far and how fast a market can move over a set period of time has exploded. We have to adjust for that. We have to know how that is going to change the type of strategies that we should be putting on, the type of risk management that we need to have in place. So we have to understand volatility. There is a seasonal component to volatility as well. Usually markets get more volatile as we get into weather markets in the spring and summer. Basis. We've all been watching as the price relationship between cash and futures has exploded here over the last few months. What is that telling us? Is it confirming what we see in the future spreads? Is it telling us that demand's actually stronger than what government reports might be having us to believe? So we have to understand basis. We have to use basis as a filter to better understand the type of market that we're dealing with. Seasonality. Again, not as important as it used to be because it's changed, but markets do have seasonal tendencies. When are they low? When are they high? Back in the day, many years ago, it was simple. Planting season highs, harvest lows. But those have changed. The influence of the investors in the markets, particularly in the agricultural markets, but even to a certain degree other commodities such as energies, seasonality has changed. We have to understand that. We have to still look for the best times of year to get risk management in place. We all just went through February. What's that? What's February do for our risk management? Steve will talk about it here later this afternoon. That's when we have crop insurance prices set for both corn and beans. The initial price is set here in the daily averages of the December corn and November bean closes. So now that we've got that out of the way, the markets might behave differently. So now we'll have to watch, see what happens. But understanding where we are in the annual seasonal cycle or the marketing year seasonal cycle is very important because we don't want to pull the trigger at the wrong time. So that's another filter that we run through. Last but not least is price. And I honestly don't believe price is as important as it used to be. Now, it could get that way by the end of the year. But remember the day when everybody was always wanting to get the upper third of the market. We were interested in being in the upper third, trying to market in the upper third. If we were end users, we were trying to market in the lower third, get some price protection on the lower third. These days, with the changed price relationship, not the price relationship, but the price ranges that we've got, we're spending most of the time in the upper 30, 40% that we've seen over the last 5 years. So this isn't as big of a deal. It's not as huge of a concern to try to get locked in just at that right price. We can run it through all of these other filters and start to establish what type of strategy might work best. Now, in order to do that, if we simply take the structure of the market, the non-commercial side and the commercial side, combine those two, it basically gives us 9 different market types that we can deal with. And once we know what market type that we're dealing with, then we have what a better idea for the type of risk management that should be put in place. Let's take an example here. Let's say we've got a lot of money, a lot of investment money coming into a market, and we've got very bullish supply and demand indicated by the future spreads. That would be a type 1 market. That would be a market where the best situation would be to be long the cash market. You want to hold on to the cash. If you're holding cash, continue to hold the cash until the structure changes. As I was driving up here today, I flew into St. Louis, and I'm going to go back tonight. But as I was driving up from St. Louis to Normal, had a call. CNBC wanted me to be on today. They wanted me to say, they were airing a segment, what's my top commodity trade right now? Well, as I'm running through it while I'm driving, obviously I couldn't be on today. As I'm running through it while I'm driving, I'm thinking, okay, what market would be a type 1 market? Well, probably corn. So my answer to them without being on would probably be long cash corn, or possibly be long cash soybeans. One of those two. I probably like soybeans a bit better than corn, given it some thought, given the possibilities of what we could see later on. But either one of those, and I don't know that that's what they were looking for, but at this time, because of the type of markets that we're seeing, that's where we want to be. Now, on the other end of the spectrum, if everybody's bearish, everybody's selling, that's a type 9, you want to be out of everything. And anything in between those two types, we can see each and every day in the market. So again, once we understand the structure, once we run it through those filters, then we can have a better idea of what type of strategy to put in place. Let's take a look at the soybean market. The blue line that you see is the 5-year seasonal index. In other words, the average of the weekly closes for the futures market. Okay? The red line is this year's weekly futures closes. Notice that basically starting in October, November, and running up through the first week of July, we tend to have a pretty strong rally seasonally, according to the blue line. But also notice that from about mid-January through mid-April, what happens? We start to move sideways. Why is that? Why does the market struggle in this time of year? We're waiting to see what South America has. Right now, the market is focused on South American production, so it goes into a lull. And we see it playing out again this year. Look at the red line. Having a difficult time breaking out. Can't really get all of the excitement to push it higher right now because there's still so much question about, oh, is there going to be a record crop in Brazil? Is Argentina better or worse than expected? Until we've got our hands around that, look for the market to stay relatively flat. But just because we're not moving up does not necessarily mean it's bearish. It just means that we're doing what we normally do and getting set, possibly, if other factors fall into place, to finally push higher. Now, what other factors could there be? That top chart, that black line, that's the same weekly closes that we just saw as the red line on the previous chart. It's the second one. Look at that second study. That is a histogram taking this weekly CFTC commitments of traders numbers for the investment or the non-commercial long futures position and plotting it out. Notice that from, say, mid-2012, or first quarter of 2012, through, just a few weeks ago, what was the non-commercial money doing? It was getting out. It didn't want to be in soybeans. The money wasn't there. They were getting out. Now we understand better why the futures market was coming down. The futures market tends to trend in the direction of the money that's, of the investment money. Money's coming out, futures market goes down. Money starts coming back in. If we start to see those histograms, we start to see those columns start to get larger, look for the money, look for the market to start to go up again. Now, the bottom line, that bottom study, is volatility. That's the red line. Notice that at the same time that the market peaked and the non-commercial money started getting out, that was when volatility was at its highest over the last couple of years. We were up around 35% if I recall. Very high volatility. Investors do not like volatile markets. Too risky. They cannot hold as many positions when the volatility is up because margin calls go up. The amount of money that they have to have tied up in margin is increased. So, volatility goes up, position starts to come down, futures market comes down as well. But now take a look at what's going on over at the far right-hand side. Again, futures market is stabilized. We've got some money starting to come back into the market because volatility is relatively low now. It's around 18%. Much lower than it was at 30%. So money is saying, we may be interested in soybeans because of this. This is a forward curve. This is one way of looking at future spreads. This is the different contracts of the soybean market all priced out on the same chart. We start off on the left-hand side with the March, May, July, then we drop off to the insignificant contracts of August and Sep, then we get into the new crop where it's flattened out a little bit of November on through the Jan, March, May, and so on. But the ones that I'm interested for this part is those first three, and really not even the March at this point because it's in delivery. But if we look at those first three, the March, May, July, what do we have? We start at the upper left and we dip down. The nearby contracts are higher priced than the deferred contracts. We have an inverted market, inverted future spreads. And that is a clear sign that the commercial side of the market is worried about supply and demand. They are not convinced that we are going to have 84, 85 million metric tons production in Brazil, that we're going to have 53 whatever million metric tons production in Argentina. The market is telling us, the May, July future spread in particular, is indicating that there is a great deal of concern about sourcing supplies to meet demand over the spring and early summer. Now, we'll get to the new crop here in a little bit, but here's another look at it. The black line is the March to May spread. And yes, it's been in a downtrend, but it's stabilizing. The blue line is the May-July. And if you notice, that blue line is starting to trend up. We're starting to see more money buying into the May contract versus the July. Again, an increasingly bullish supply and demand situation, regardless of what government numbers tell us. Yes, we'll get another set this Friday, Yes, we'll have about 10 seconds worth of hysteria, but then we're going to go back, and the market really isn't going to change its nature. It's not going to change its structure. People are going to get excited. People are going to want to see the numbers. People are going to want to do this. People are going to want to do that. But the structure of the market will not change because of those numbers. We could see the structure change before the numbers come out. We could see a change after the numbers come out, but it certainly won't be because of the numbers. So why would non-commercial money start coming back in? Volatility is low. Seasonally, this is the time of year when we could start to see it start to rally again. And fundamentally, soybean market is bullish. So that's what they're looking for. Now, if we want to look at world fundamentals, if we actually want to get down and look at the fundamental situation in soybeans, I don't do a lot of this, doesn't really make any difference to me. But the green column is global supplies. The red, I believe, the red columns are total demand, global demand. The black is ending stocks to use. Now, if you are one of those that love to watch government reports, don't blame me for that because they are a lot of fun. I get more entertainment than information from them, but they are fun. They are fun to watch. But if you want a Reader's Digest version on how to better understand, better bullish, bearish, whatever, better understand how the report is, simply look at the ending stocks to use. Take ending stocks divided by total demand, that gives you ending stocks to use. The lower the number, the more bullish the report. The higher the number, the more bearish. As we see in that black line, in the February report, it was actually a little bit bearish. I mean, we saw the huge production in in Brazil, Argentina as well. Really kind of a wash, no reduction there. So the ending stocks to use actually increasing a little bit. But in Friday's report, do not be surprised if that ending stocks to use number doesn't come down a little bit. Because I think we will finally start to see some reductions in Argentine production, and global demand is going to stay strong. This ending stocks to use is all about showing both sides of the market. Total demand is supposed to stay up. Total supplies could come down. So I would anticipate global ending stocks to use coming down a little bit, reflecting or confirming what we're already seeing take place in the future spreads. All right, let's see what this is a little differently. This is the world number. Let me tell you, my eyes aren't what they used to be. Looks like I've got a few. There we go. Sorry about that. This is another look at the world fundamentals, where the green line is world ending stocks. And again, the red line is ending stocks to use. And again, you can, instead of comparing just supply and demand, we're just looking simply at ending stocks at this point, with the red line again dipping down. So if we reduce production in South America, and if total demand stays strong, that green column is going to fall again. Ending stocks are going to come down again. And again, I think that's what the future spreads are trying to show us at this point. Is just simple fact that the market is far more bullish than what we're seeing in the numbers. Now, there's a lot of talk about U.S. acreage, and that talk is just going to heat up as the spring goes on. This chart shows corn as the blue dots, soybeans as the red dots, and wheat as the green dots, I believe that is, with the lines, kind of the trend line of what we've seen in growth or reduction in overall acres. Now, look at corn compared to soybeans. Corn continues to pull away, and what are we hearing this year? Possibly 98, possibly 99 million acres of corn. Yes, soybeans are supposed to increase somewhat, but not to the same degree as corn. Wheat could be one of the losers. Certainly cotton could come under pressure. Their acres could see another reduction. So, even as we're going into this year, we've got a relatively tight situation, both domestically and globally. Domestic ending stocks to use right now is pegged at the tightest on record, around 4.1%, I believe it is. Probably going to tighten up a little bit more. Yet, we're still supposed to see more corn acres. Now, one quick aside. Those of you who are familiar with DTN will know where I'm going with this. Ending stocks to use in soybeans. What's the bottom line? What's the floor? Anybody know? 100 100 million bushels. I think you're thinking of corn, but in soybeans, U.S. soybeans will not go below 100 million bushels. Just not going to happen. So right now we're pegged at 125. Our export pace is well beyond what was projected right now at 1.345 billion bushels. Yet, in February, exports weren't changed. Crush was picked up 10 million bushels. That's what lowered us to 125 million bushels. We will see some very creative accounting to keep U.S. ending stocks above 100 million bushels. But the reality of the situation is 100 million bushels against the type of demand that we're seeing is not what it used to be. Again, ending stocks to use down around 4%, the tightest on record. So just when you're watching these reports, if you want to see something kind of fun, check to see when we get close to 100 million bushel, the type of erasures and rewritings that start to occur in the demand columns. Always is good for a laugh, but certainly something to keep an eye on. Talked about basis. Okay, let's get back to what we were looking at here in the market. So we talked about basis. The red line is the strongest national average basis, which is the DTN National Soybean Index minus the nearby futures contract. That's the strongest it's been over the last 5 years. Blue line is the weakest it's been over the last 5 years. And again, this is just simple cash relationship to futures. And the blue line, the purple line, that's the 5-year average. The green line is where we are in 12-13. Look how strong basis is. We've got a very strong cash market right now for soybeans. There is a lot of demand that I don't think is being accounted for yet, but is certainly showing up in the future spreads, that inverse that we see in the future spreads. So in this case, soybean basis seems to confirm what we're seeing in the future spreads. Now, as we note, as the marketing year goes along, basis tends to firm even more. The question that we're going to see here this year is if the futures market really takes off, and if South American production is actually quite as large as what they're talking about, will the cash market be able to keep up with futures? Seasonal indications would show that it normally does. Right now, we've got a great deal of demand for U.S. beans. We'll have to see. This will be a very important year to keep a close eye. This will be, it's very important to keep a close eye on basis this year to see how the cash market continues to relate to futures. Right now it's very strong. As long as it stays strong, it's going to give us a good market. This is one of the reasons why one of my favorite markets is being in cash beans, other ones being in cash corn. But the future spreads and everything else, the seasonality certainly seems to be indicating the bean market's quite bullish. So, taking this into account, taking these factors into account, what do we know about the old crop soybean market? Number one, neutral structure right now. Moving sideways, investment money's not showing all that much interest, but it could. Fundamentally, it's quite bullish. Fundamentally, there's a lot of supply and demand reason for the market to go up. So it looks like at some point the market is going to try to rally. Seasonally, we tend to post pretty good rally from, say, mid-April through early July. So all the pieces are in place to show that this market could start to gain some momentum, and it certainly raises the question, does the market even believe the numbers that are being talked about now in South America? All right, so what would our outlook be for the soybean market? I'm going to get over here so I can read it a little better. If we just use the seasonal index by itself, and I think it rallies something like 31% from its late fall through early summer rally. So if we take all of that into account, it would indicate a top of about 1790, which is a challenge of the 2012 high. That may be a bit ambitious. So just using the seasonal index itself may be a bit much. I don't know that it's quite that bullish, because remember, we don't have as strong as an inverse as we used to have, but it still is a bullish market. Could we get to the 16.5? I think so. I think it's a much more realistic target. Anything above and beyond that is going to come from a South American crop problem. Continued strong demand for U.S. supplies, pushing the market higher. South America isn't there to offset all of the problems. I think that's what could take us back close to 18 if it happens. Right now, I think the market could get back to 16.5, futures market. 1790 is an outside possibility. Here's what we're looking at. Again, don't worry about all the technical gibberish on these. But again, what we're basically looking for is just simple price direction over time. This is the monthly chart. Notice how it came down, has stabilized, and looks to be kind of forming a chance to start to move higher. That 16.5 is kind of that upside target that we would be looking at, getting all the way back up to that, I believe it's a September high of right around 1789, 1790. Again, I think it's going to be a little bit difficult, not out of the question, particularly if fundamentals and local fundamentals of basis stay as strong as they are. So how do we position ourselves for the soybeans? Right now, you know, you could almost call this a type 1 or a type 4. We really can't call it a type 1 because we don't have the money coming back in, but we're anticipating it coming back in. So either way, type 1, type 4, still long-term bullish. Seasonality still looks like it's going to go higher. Basis is really quite strong. So if we are holding cash soybeans, a possible strategy would be just to continue to hold those soybeans. You know, holding the cash beans. You know, in a type 4 market, you want to be long at least a little bit. Type 1, you want to be as long as much as you can. So either way, you know, it certainly looks like if we're still holding cash soybeans, we're going to have some opportunities to sell them here this spring, possibly as late as early summer. But once this thing turns, it could turn very quickly as we've seen in years past. So we want to be kind of cautious with it, but right now, certainly looks like a bullish market going forward. Well, what about new crop? New crop has a little bit different situation. You notice that in this November chart, a lot of wiggling going on, but kind of trying to work a little bit lower. The future spread, which is the center study, and it's the one that we looked at right here, notice that instead of the inverted situation that we've got over in the old crop, we've got a very small carry situation. In other words, the January contract is just slightly higher priced than the November. March is a little bit higher priced than maybe the January. But overall, there's not much price difference. This is unusual given the idea that we're going to see such record production and strong yields here in the United States again. What this is indicating, market doesn't believe that yet. Market is still concerned about carryover supplies from the old crop going into the new crop. That we don't have the situation well in hand, and therefore it leaves the door open, just as we saw in the old crop market, for a decent spring-summer rally in the new crop market as well. That just because there's all this talk of record production doesn't mean this market's coming to an end yet. Future spreads, certainly the indicator to show us that we've still got some room, possibly, for the new crop market to move. So how do we want to approach, and what's our outlook for the new crop market? Again, relatively neutral market structure. We saw in the futures trend itself, not really going anywhere, and it doesn't have the buying coming in, even that we're seeing right now in the old crop market. So a little bit of a struggle, and the future spreads aren't inverted like they are in old crop, but they only have a very small carry. So I'd still call it bullish. So still a relatively neutral to bullish, and it looks like the market could get increasingly bullish as the spring moves on. So what do we want to do with so what would the outlook be? Right now, given what we know, and given that this winter we really haven't seen the drought situation reduced all that much. Yes, we've had some very nice snows move across, but by and large, drought is still with us. The Western Corn Belt in particular, still suffering from drought. So it remains a question. I think that's what the future spreads are really reflecting. Yes, we could see an increased acres. Yes, we know that we're probably going to have fewer beginning stocks than what we were planning on. But the real question mark is in production 2013, and a lot of that is going to come back to weather. So leaving that wild card in, it looks like we should be able to get back up to about 1360, possibly challenging the high from 2012, right around 1410. More comfortable in that 1360, obviously, because of the structure that we have right now. But I'm not going to discount if we see another weather market develop, and we see a weather market develop almost every year. I'm not going to discount the idea that we could see soybeans, new crop soybeans, get back up to almost 1410. So certainly looks like it's got some room to run as well. All right. how do we work with this market? Again, I probably wouldn't call this one as strong a 1 as I would in the old crop. This one I'm going to still leave as a 4. That being the case, what I would be looking for is have some sort of option strategy in place at this time. Those of you, and again, Steve will talk about it later, those of you with revenue insurance basically have that now. So there's really been no reason to do much else in the futures or option markets. We're just entering the time of year when the markets tend to heat up. We've already got the insurance prices set, so that basically establishes an option price for us. Now let's see what happens. And seasonally, since the market tends to move higher, I think we're going to have some opportunities here over the next few months to get some better prices locked in. So right now, I probably wouldn't have a lot on the books. If I did have anything, maybe a few forward contracts just to get the process started. But certainly, I wouldn't be overloaded on forward contracts at this time. Let's see what develops. Let's see how tight beginning stocks for 2013-14 are, which are the ending stocks for 12-13, and what the early crop looks like, that early season move in say April and May. Let's see what happens there. Then we'll start to pull the trigger as the structure starts to change a little bit. This is a look at all right, so that's our soybean situation. How are we doing on time? We've got a few minutes here to talk about corn. I'll kind of buzz through corn just to show you the relationship that soybeans have to the corn market. Again, notice that in the corn market, blue line seasonally, we tend to move up from the fall through, say, mid-June. This year, the market has been very reluctant to make that move. We did post a low, later low than normal, and we just seem to be regrouping at this point, and the market's finally starting to stabilize, looking like it may finally want to join its seasonal uptrend. Again, looking at the CFTC non-commercial long position, the blue columns, you can see the relationship it has on the futures market, but look at the volatility. This is where corn is actually more interesting than soybeans. Remember, volatility in soybeans was around 17 to 18%. In corn right now, it's around 15 to 16%. Corn, it seems like traders, despite today's sell-off, are looking for a reason to buy into corn. Now, yes, demand isn't in corn like it is in soybeans, or at least that's the theory, but it certainly has low volatility that could be an open invitation to investment traders to come in. And this is what's interesting. Now, this chart is a little bit outdated, both this one and the next. Again, you see the same sort of inverse in the old crop future spreads, but here's a better picture of it. Here's the futures, the trend of the future spreads themselves. Take note of the green line. I believe it's the green line. Yes, green line is the May to July. When I sent this in to have it ready for this presentation, we were just testing the old high that we had seen. Since then, the May-July inverse has exploded well beyond 20 cents. We have a great deal of commercial buying coming into the corn market right now. There is a lot of bullishness in the fundamentals of corn. How is that possible? All we hear about is demand going away. But right now, the market itself is indicating commercial traders are having a difficult time getting a hold of cash supplies to meet demand. And so we've got a huge inverse, actually a stronger inverse in the corn market than even what we see in the soybeans, even though we don't, by headlines and everything else, we don't have the same sort of supply and demand situation. Basis, again, very strong for corn, actually much stronger percentage-wise than what we see in soybeans. We've actually gone to a plus basis on the national average. We're something like 3-4 cents over the May, or I think it's now over the 12 cents over the 13 cents over the May contract. So we are at a plus basis for national average, something we just normally don't see. This strong of a cash market. How is that possible if we're not moving any, we're not feeding any, and ethanol is a question? This tells us there's more to the market than what we're hearing about, that there is a lot of concern about sourcing supplies. The market is well supported by its fundamentals at this time. So what type of situation do we have? Corn, again, very similar to what we see in soybeans, is that we really haven't seen much investment money coming in, but we have a very bullish supply and demand situation, which certainly should help us out as we go forward. Also, seasonally, the market tends to rally about 25% as opposed to the 31% that we normally see in soybeans. So again, we still see a very strong rally up through about mid-June in the corn market, indicating that we could just be on the cusp. We could just be at the threshold of seeing corn get ready to move. So what's the outlook? Right now, given what we know, and again, using the seasonal patterns, we could certainly see, the 650 range, I think is what I've got written on there, excuse me, 680. Using the 680, seasonally, that would project out to the 850 mark, which would again be a test of last year's high, more realistically, somewhere in that 760 to 790 range. Certainly seems like a more realistic target because it is taking us a while to build some non-commercial support, to build some investment interest in this market. But I think once it takes off, then I think we're going to be able to push it relatively quickly. And here again is a look. Also, just as in soybeans, while we may challenge the 2012 highs, one thing that we'll be covering on DTN as the year progresses, if we don't take out last year's highs, we may be looking at a market that's probably seen its peak, both corn and beans. And that's why I think this is going to be a very interesting year, because this could be the capstone year in the corn's demand market. The demand market that has pulled and pushed and done everything it can to get not only the other grain markets, but agriculture in general to a much stronger level. I think that could be severely challenged this year if we have another drought. Because with another drought, we lose the demand that's pushed us to this price level, to these price levels. A lot of people think, oh, a drought would be bullish. No, I don't think so. We may see higher prices for a while, but in the long run, I think a drought's going to do more damage to the price, to the market, than if we have a relatively large crop. So what do we do with old crop corn? Again, this would be about right now this market would be rated, I've got it as a 1. Again, it fluctuates between a 1 and a 4 depending on the day, but still in that same situation. If we're long cash corn, and we've held it this long, continue to hold it. I like holding the cash corn. I like the basis market. I like the future spreads. I like the seasonality. Certainly it looks like the market should be able to go up. New crop has been a bit of a problem. All this talk about 98, 99, 100 million acres, certainly telling us that this market may struggle for a little while. But again, future spreads, if we look at let's see, which line is it? The second line, D's to March, future spread, just as we saw on the previous, there we go. We've got a little bit of a carry in the D's to March, March to May, May, July. So we don't have as bullish of a commercial outlook in the new crop market as we do in the old, certainly not as bullish as what we see in soybeans. So there's a reason why we've still got new crop futures kind of under some pressure. Markets tending to believe that while we may not see all of the 99 to 100 million acres, and we certainly may not be out of a drought situation, they certainly tend to think, the market's indicating, we may be in a better situation than we've been in the last few years. Is it going to be a 163 trend line? No, probably not. Trend line is just a statistical anomaly. Doesn't really mean anything. Trend line yield. It all comes down to weather. Right now, market's seeing a little bit better weather situation, so that's why we've got some carry. So what do we do? The market situation right now, I would say, relatively neutral again, maybe a little bit bearish. Volatility is still one of those things that could help pull the market back up in the long run. So if I'm looking for an outlook on the December corn contract, I think we could get back up into that 610 to 630 range without much problem. I think over the spring, we should be able to see the market rally a little bit. Could we get back up to the high of, roughly 665? Going to take some doing. We're going to have to see some sort of problem. And if the problem is a drought, we'll probably shoot past the 665. But then by the end of the year, we should be probably below. We will probably be below where we were last December on the way back down. So real tough situation in the corn market. I think we're going to have some marketing opportunities as we go forward, but we're going to have to be very cautious, because if those spreads really start to see a build in the carry, then this market's not going to go very far. Here's a look at the drought situation. At least I think that's as of late January or mid-February. Notice that even with some of the winter storms that we've seen, this huge pocket of drought over the western corn belt, and Bryce Anderson and I have been doing a lot of speaking, a lot of talking about this, we're going to have to see so much precipitation occur between now, planting season, growing season, to start to alleviate some of this, that at that point it raises other problems for the crop. So right now, going into the 2013 crop season, we're actually in a worse situation than we were last year. The weather's going to have to really cooperate because, a lot of the talk of, okay, we're going to see this 98, 99. Where's the acres going to come from? Well, we're supposed to see them down in the south. We're supposed to see them in the northern plains. And you get a kick out of this, we're supposed to see it in the southern plains. Why in the southern plains? Because the wheat crop that was dead going into dormancy because it was too dry might get worked up and replanted to corn. Think about that. It is too dry to grow wheat, so we will grow corn. I'm from Kansas. I want to see that happen. I've watched over the last couple of years irrigation levels going down, water restrictions, all of these things. If the weather does not cooperate, I think it's going to be very difficult to put more acres in Kansas, in Texas, in Oklahoma, even parts of the northern plains, to move them from wheat into corn. I think it's going to be very difficult. And if we do, what's that going to do to trendline yield? Again, we all saw the numbers come out. Steve will talk about them later. What, 163, 164 trendline yield? Where are the acres coming from? Ground that isn't optimum. It's going to be very difficult to produce those types of yields. So if we see the acreage increase that everyone's talking about, that makes it even more difficult to hit trendline yield, meaning that somewhere in that 145, 150 bushels per acre is probably more realistic. Here's a look at trendline yield, and again, those of you who know me know I don't put any faith at all, any stock at all in trendline numbers. I say use a moving average if you're going to use anything. Moving average would bring us in again around that 145 to 150. So what do we do with the new crop corn market? Be a little bit cautious with it in here. Certainly you can start to get some selling done, some forward contracting done, just as in new crop soybeans, but I'm actually a little bit more bullish on new crop soybeans than I am corn, so I will use these opportunities to get some locked in, see what prices we can get covered, and then kind of hold some back in case we do get another weather scare. We hear all this talk about the soybean corn ratio, and what does it mean? Well, if we look, we're about where we were, this 2.25 to 2.3. I think we were right around 2.28 at this point. That's right around average over the last 5 years. And remember back to that acreage chart. What have we seen the last 5 years? Corn gaining on soybeans. So by all looks of the markets right now, soybeans have not done its job to buy acres away from corn. So we should be looking at a situation where the corn acres go up, and that's going to make it even more difficult, again, to hit that trendline yield because soybeans did not buy the acres back this year. Even with the averages that we saw in February, still came out about that 2.28 to 1. Far cry from the 2.5 to 1, the historic level that kind of was the break point of more acres going into beans versus corn. We haven't been there in a long time. And we've seen corn acres, the corn belt in the United States, just continue to grow. Okay, that's got my part of it. Here's all the information, all the different ways you can contact me. Feel free to use any of those ways. If you've got more questions, if you've got questions after this event is over. Again, I appreciate everybody coming out. This is a great event. I appreciate the Illinois Soybean Association's invitation for me to come speak, giving me the opportunity to visit with all of you. Have a great rest of the meeting. Unfortunately, I'm going to have to take off quickly here afterwards and head back to Omaha. But again, I do appreciate the opportunity. Did enjoy visiting with you this afternoon. Thank you all so very much.